Imagine you walk into your bank and ask for a $10,000 loan. The banker smiles, types for a moment, approved, $10,000, sitting in your account. But hold on, where did that money actually come from? Because here's what most of us picture. The bank takes savers' deposits, locks them in a vault, and lends that same money out to borrowers. It's a tidy story. It's also wrong. Banks don't lend out existing money. They create new money at the exact moment you sign the loan. They don't even own a printer, just a keyboard, really. And it works this way in nearly every country on Earth. In school, most of us were taught something called the money-multiplier model. Banks collect deposits, keep a small slice in reserve, and lend out the rest. That loan gets deposited somewhere else and lent out again and again, until, at least in theory, $100 of savings has become $1,000 in circulation. It's in every textbook, it's on the exams, it's elegant, it's logical, and there's just one problem. It's wrong. That is simply not how banking works, not even close. In 2014, the Bank of England published a bulletin called Money Creation in the Modern Economy. In it, they wrote, "The reality of how money is created today differs from the description found in some economics textbooks." That's the Bank of England, not a blogger, not a conspiracy channel. The actual central bank, saying what we learned in school is wrong. If you're enjoying this, hit subscribe for more. So what's really going on? When you take out a loan, nobody walks down to a vault, and nobody touches anyone else's savings. Instead, the bank opens your account and types a number in. On the bank's books, your loan is an asset, your deposit is a liability. Both sides, 10,000, everything balances. Let's slow that down and watch it happen line by line. Before you walk in, the bank's screen shows nothing for you. You sign, and the banker types 1, 0, 0, 0, 0. The instant they hit enter, $10,000 exists that did not exist a second earlier. No gold moved, no savings moved. A number was written, and that number is money you can spend. And that's not a figure of speech. That is, literally, double-entry bookkeeping creating money out of an agreement. Their words, not mine. Whenever a bank makes a loan, it simultaneously creates a matching deposit in the borrower's bank account, thereby creating new money. So the amount of money in the economy isn't set mainly by government printing presses. It's set by banks making loans. And here's the scale of it. Only about 3% of all money is physical cash. The other 97% was created by banks as loans, exactly like you just saw. Every mortgage, every business loan, every credit card swipe, each one creates brand new money. Now, maybe you're thinking this is just one bank's odd opinion. It isn't. Every major central bank on Earth describes money exactly the same way. Germany's Bundesbank says it just as plainly: banks do not lend out savings. They create new money with a keystroke whenever they lend. The Federal Reserve runs on the very same mechanism and says so openly. Commercial banks create the dollars in your account when they lend. The Banque de France spells it out too. Most money is created by private banks, not by the state. The Bank of Japan? Same answer. The money in people's accounts is created through lending. And Switzerland went furthest of all. In 2018, the Swiss actually voted on whether to take this money-creating power away from private banks. The referendum itself was the proof. That is exactly what banks do. Different countries, different currencies, the same hidden machine. So if banks create money when they lend, then banks, not governments, largely decide how much money exists. Central banks set interest rates, the price of borrowing, which granted has a massive impact on whether people and businesses take out a loan or not. But it's commercial banks that choose who actually gets loans and how big they are. And a natural conclusion of this is that the total money in existence is roughly equal to the total debt in existence. When debt grows, the money supply grows with it. Which raises a real puzzle. If a bank can conjure money with a keystroke, why does the economy ever run short of it, like in a crisis? Can't banks just make more? When banks lend freely, boom times, they flood the economy with new money. Prices climb. Everything feels great. And when banks get scared and pull back, they don't just stop creating money, they start destroying it. Because when a loan is repaid, that money doesn't move somewhere else. It's deleted from the economy. Gone. And once you see that, you finally understand why 2008 was so catastrophic. In the mid-2000s, banks were approving mortgages for almost anyone. Every approval minted brand new money, and it poured straight into housing. Prices climbed far faster than wages ever could. Then the loans started going bad. Banks panicked, and almost overnight, they stopped lending. And remember the rule: no new loans means no new money. While every repayment quietly deletes money that already exists, the money supply didn't just stop growing. It shrank. That's what a credit crunch really is, not a sudden unwillingness to spend, an actual shortage of money itself, because the machine that creates it had switched off. And there's the answer to our question. Banks could make more. But in a crisis, they don't, because they don't think people can repay their loans, so money itself runs short. Okay, that's the machine. Now the part you can actually use. Most of us were raised on one rule: debt is bad, avoid it. So let's take a closer look at debt. Here's the uncomfortable math. Stocks and houses rise faster than wages, so if you only ever save your salary, you fall a little further behind every single year. And a savings account isn't as safe as it feels. Earning 0.5% while inflation runs at 3%, your money is quietly losing value. That's a real return of minus 2.5% a year. Your purchasing power shrinks, while the balance looks just fine. So, what should you actually do? Here's the principle. Cash in the bank loses to inflation. But borrowed money, used to buy real income-producing assets, puts the machine on your side. One honest warning: leverage cuts both ways. It magnifies losses just as fast as gains. The rule that keeps you safe: only borrow against income-producing assets you could still cover if your income stopped tomorrow. Used wisely then, the easiest way for most of us to benefit from money creation is to take out a loan from the bank. Because here's the thing, not all loans are equal. Start with the one already in your pocket, the credit card. Every swipe creates money for the bank, so let's make some of it flow back to you. 3 ways. First, rewards. Use a card that pays you for spending you'd do anyway. A flat 2% cashback card is the simplest version. That's the bank handing you a slice of the machine. Second, protection. Many cards quietly include purchase protection, extended warranties, sometimes even travel insurance. It's built into the swipe, and most people never claim a cent. And third, the best one, the float. Buy on the card, and your own cash sits in your account for up to an extra month before the bill is even due. Park that cash in a high-yield savings account or an offset account against your mortgage, and that quiet month earns you interest. But here's the rule that makes or breaks all of it. Pay the full balance every single month. Slip once, and 20+% interest wipes out every point, every perk, and every cent of float. The card only works for you if the bank never collects a dime of interest from you. And you can make sure you always pay in full. Just set up an automatic rule. Next, the biggest loan most of us ever sign, the mortgage. Here, one number, the interest rate, has a meaningful impact on whether the house makes you richer or poorer. So if you already have a mortgage, work your rate. On a $1 million loan, shaving just 0.25% off your rate saves around $160 a month. And here's your early warning system. Central banks move rates slowly over many months, and they telegraph it on the news. When the headlines point up, you usually have time to lock in a fixed rate before the increases fully land. Watch that cycle, and the biggest bill of your life starts working with you. Buy or refinance when money is cheap. Fix your rate before it gets expensive. One more loan people forget, the car. Leases and car loans are bank-created money too. Same machine, same rule. And right now there's a twist worth knowing. Many countries and states still offer real tax breaks and incentives on electric cars, on top of what you save on fuel. But those windows don't stay open forever. Some have already closed. So if a new car is in your plans anyway, it's worth running the numbers while the incentives last. You will never outsave this system, but you can absolutely position yourself on the right side of it. Recapping your action list. 4 things. Use debt for assets that earn more than they cost. Stop parking long-term money in a savings account that loses to inflation. Watch interest rates. They tell you when money is cheap. And run your credit card so the bank never earns a cent from you, while you collect the perks. Step back, and the whole picture snaps into focus. In this system, money is not printed and handed out. It is born as debt the instant someone borrows. And that timing is everything. Whoever is closest to that new money, the banks, and whoever borrows first and biggest, gets to spend it while prices are still low. Economists even have a name for this, the Cantillon effect. Newly created money and credit don't spread evenly through the economy, which steadily widens the gap between those closest to it and everyone else. Sit far from the tap, holding only cash, and your purchasing power reduces steadily. You quietly pay the bill for everyone ahead of you. Sit close to the tap, own the assets new money flows into, and inflation quietly starts working for you instead of against you. That is the whole game. You don't have to like this system, but understanding it is non-negotiable if you want to build wealth inside it. So let's recap. Banks create new money when they lend. Repaying loans destroys that money. Central banks set the price of borrowing, but banks decide how much money exists, and not all loans are equal. Used well, cards, mortgages, even car loans can put the machine on your side. And the master key, the closer you sit to where money is created, the more this system works for you instead of against you. It all comes down to a shift in thinking. The old way, save everything, fear all debt. The new way, understand the system and use it deliberately. Knowing how to navigate the system is a game changer for your rate, your savings, your debt decisions. So go ahead and hit subscribe, and I'll see you in the next one.